what I want to talk about today is rent to own. A lot of you have probably heard rent to own at some point in your existence. You know, people talk about it. Hey, you can do rent to own. I mean, at the end of the day, I'm going to talk about rent to own from two perspectives. And I'm going to share some things here on the board, but I have a PowerPoint for you from all aspects, whether you want to be a tenant buyer or you want to be in a position where you can create a rent-to-own company and attract tenant buyers and connect them with potential investors. Maybe you want to use this particular strategy to buy buildings. Right? You can buy buildings, we call them master leases or lease options or agreement for sales. So this strategy, rent to own, means that you don't currently own it, but you are working towards it. At some point in the future, there is going to be a transaction. For a lot of young people, this could be a really good choice, a good way to get into the market. For example, a rent to own, you don't really need to have credit. You don't really need to have, if your credit there's something wrong with your credit or it's compromised in some way. Well, this is why someone would do a rent to own, right? So they need to be in a position where they need time to be able to fix their situation. I've done multiple rent to own deals. And for me, it can be a really, from the investor perspective, it can be a really great way to not only earn profits, because it does become very profitable, but it's also a way to help someone, right? Because you're helping someone in need, and so that really becomes powerful, and that's why I love rent to owns. Now, I wrote some things here because I wanted to make sure that we understand exactly all of the terms, because rent to own, sometimes people use different language and different terms, and I wanted to make sure that you guys fully understood all of the terms. So the first one that I have is lease option. Lease option, meaning you're leasing with the option to buy. Okay, that's the same thing as a rent to own. Okay, so you'll hear these different terms out there, and so I don't want you to get confused because ultimately they all mean the same thing. You may hear RTO. RTO. People may talk a lot about RTO, basically rent to own. And so RTO, people say, hey, are you guys doing the RTO strategy? Do you know about RTOs? Then you know exactly what they're talking about. They're talking about rent to own. Now, from the other perspective, if you're buying, right, you could buy duplexes and triplexes using the rent to own strategy. And the reason I bring this up is because sometimes you just need a little bit of time to get all your ducks in a row. And you might not have the finances at the time. You may not have the credit at the time, or the job, employment, whatever you need. So from a tenant buyer, okay, from a tenant buyer perspective, so this is what we call people that are actively doing the rent to own. They're tenant buyers, and so you could buy a duplex, you could buy a triplex. We call this master lease. Master lease. So basically, you take over all of the units. I've done this strategy, and we call it agreement for sales for bigger deals. Guys, if you guys are coming in, please mute yourselves. Hold on a second here. I'll have to see who's that. Okay. Okay. Thank you. So we call these master leases. So in the past, I've gone in there and I've secured a deal, 21 unit apartment building. So I've bought apartment building using this strategy, being a tenant buyer. In this case, I'm not a tenant, but I am creating a deal today. It's an agreement for sale that in the future I will exercise my option. But now I have a master lease where I control all of the units. I get all of the income, I pay all of the expenses before I actually have to get a mortgage or transact. So why is that good for me as an investor? Well, I get the opportunity to increase the value of that asset. So by the time I close, the property is actually worth more than the original agreement. Meaning there's been situations when I've closed on a deal and I'm actually getting a check back. So I'm walking from that closing table, from that lawyer's office with a check in my hand versus going to the lawyer's office and having to give them money. And so this can be a really lucrative, really great opportunity for you to know how to negotiate these types of deals. So you could be the tenant buyer in this case, where you can get yourself a duplex or a triplex on a master lease. So you have these two units, you have maybe you move into one of the units, but you have two other rents that are going to help you buy that property. And so this could be really, really good, especially if you're young and there's issues with your credit. It could be a great opportunity for you to get in the game. Here's what it actually does. You control the property. And that's what's most important. You get to actually have control over the property, and you get to add value to it, increase rents, renovate it without actually having to transact. You get to build equity during that time, right? The best time to get into real estate is yesterday, and the second best time is today. And so you get into you're no longer a spectator. You actually get to get in the game, and let's say you have some issues with your credit or job, or you don't make enough money yet, or you're just starting a family, or you're a newcomer to Canada. There's so many reasons why you may want to do a rent to own. And from the person that owns the property, they actually can realize a higher return. So there's a real exchange of value here, and it actually there's a benefit to the seller for actually doing a rent to own with you, and we'll talk about some of those benefits. The other one, okay, I'll continue on here. The other one is there's forced savings. Forced savings. So, for example, let's say you're trying to save some money to try for a down payment, for example. Well, it may be tough because every time there's you have, like, let's say 5 or 10,000, there's always some sort of emergency, right? And so very similar like a mortgage, when you have a rent to own agreement, there's a certain amount that goes towards the purchase price at the end. And so that now becomes like a forced savings. It's like mortgage, right? You pay your mortgage, you don't realize that you're also paying down the debt. And then eventually you paid off that mortgage. And so it's very similar. There's going to be a rent component, and there's going to be a credit that's going to be applied afterwards. And so this can be really amazing for someone that maybe they have issues managing money, or they tend to every time they have savings, there's always some sort of emergency. In this case, you're being forced to save that money and get into home ownership. Let me see here what I have. Build equity for savings. Oh, here's the other one. You could create a rent-to-own company where you put the investor and the tenant together, right? So you could create a situation where you're marketing and finding tenant buyers, and then you're marketing and finding investors, and you're putting them together, and the result is going to be you get these option. Let's say you have something on an option, and then you resell it on another option. you'll make like 20, 30,000. You could be the facilitator of the transaction. If you're the facilitator of the transaction, you can make like 15, 20,000 on a transaction. Then you manage that deal throughout. You'll make like cash flow, let's say of about, $300 a month. So it can be very lucrative as a business. So let's talk about, did I say lease to own? Lease to own? Let me see. Oh, no, I talked about lease option. The last one, you may hear lease to own. Lease to own. You may hear that. It's the same thing. Okay? Some people may refer it as a lease to own. Some people may refer it as a rent to own. And then the last one, where when you're trying to do this with bigger apartment buildings, bigger units, it's called an agreement for sale. An agreement for sale. Okay, this is when you create a master lease and you take over all of the income, you pay all of the expenses, and then you have an option at some point in the future to transact on that deal. Now, how does this work? Okay, how does it work? Well, essentially you want to attract a tenant buyer. Okay, and I'm going to simplify this for you from the investor's perspective and how you transact. But this tenant buyer, for whatever reason, they cannot buy a property conventionally. And so when would this happen? Well, let's say someone has either bad credit for some reason. They may be a newcomer to Canada. Well, that's a huge opportunity for us. I think in 2022, the government of Canada is trying to catch up on all their immigration that was missed. So I think we're expecting about 1 million new immigrants in Canada. A lot of these immigrants are looking to come to Canada, settle down somewhere, and they want to participate in home ownership. Well, a lot of them don't have they don't have a history, they don't have credit, and so rent to own could be a great opportunity for them. Younger people are having trouble qualifying with all the new mortgage rules for mortgages. Also, the prices keep creeping up, and younger people just don't have the down payment required in order for them to make a transaction. And so this rent to own could be a great strategy for someone to get started. I personally do a lot of rent to owns. I do them. I like to do them, kind of in the Brockville, Prescott area into Kingston. But what happens is you attract some of these tenant buyers, and you can do a transaction. What I'm looking for is at least a 5% deposit. Okay, so I'm gonna talk about a scenario, a deal that I've done. So we were looking at this deal that it was 210,000. Okay, so 210,000. We took a $10,000. We took a $10,000 deposit up front. The term of the deal is for 5 years. Now, usually around this, if you haven't heard of rent to own before, and someone says this tenant is going to give you $10,000, you would think, well, wait a minute. If someone has $10,000, why can't they just buy their own house? Well, first of all, $10,000 is not nearly enough to be able to put down on a house, especially these days. Number two, maybe there's something about their history, their credit history, or their job, or their employment history, or just history period, that does not allow them for them to be qualified for a conventional mortgage. And so, in essence, they can't buy a house conventionally, and all they have is this $10,000. And what happens is, if someone just keeps that in a bank, Well, you know what? If you're saving away for a rainy day, what are you going to have? A lot of rainy days. And so what happens, when someone has $10,000 for or five or $10,000, there's a next emergency that comes. The next car, the car breaks down, and so usually people want to get into home ownership because they know that's a really great way to build equity, and ultimately, at some point in the future, they'll be able to transact. But they get to enter the market today, which is what's important. And so this $10,000 really, it helps you as the investor pre-qualify the type of tenant buyer that you're going to have. And so this $10,000 is a security for you that you know that person is not going to go anywhere. We've talked about it before. There's a reason why single homes are bad investments, right? So we have the single door and we have the multifamily, okay? And we had multiple conversations on this before. Single home, you have too many leaks. So you got to pay taxes, you got to pay the water bill, you got to pay insurance, you got to pay your repairs and maintenance, you got to pay your gas, you got to pay your hydro, roof, snow. I mean, I can go on and on and on and on and on, showing you all of the leaks of this single family home. But the problem is you only have one income. One income taking care of all of these expenses. This is why the single family home is literally the worst investment. Because there's too many leaks. There's not enough money coming in, and there's too many leaks. Now, the multifamily, you still have all of these expenses, but you have multiple incomes. For example, multiple tenants. If this is a 6-unit building, I have 6 rents coming in. 6 rents coming in versus 1. If this person moves out, you're now on the hook for all of these expenses. Versus if one person moves out, I still have 5 other incomes paying for all the expenses. And so why do I mention this? I mention this because when it comes to rent to own, this is the very first time where that single family house will actually make sense. Because the tenant buyer now, because they are now a tenant, but they're also a buyer, they're a tenant, but they're also an owner, they now take care of all of these expenses. And so that you no longer have these expenses, and that one income becomes secure because that tenant buyer is not going anywhere. And so you have now one income. Of course, you do have to take care of your taxes, but you have that one income, and this is why you'll see cash flow in some of these deals. Going back to this. This $10,000 actually secures, gives me more security that that tenant buyer is not going to go anywhere. And so based on human engineering, this $10,000 is non-refundable. Okay, so meaning if that tenant buyer decides to walk away, they're walking away from their $10,000. And so to me, that gives me the extra security to know that I'm never going to be on the hook for all of these expenses. Okay, and so that's why I love rent to own. And the reason I love rent to own is because, number one, there's no property management. Why? Well, the tenant buyer is actually managing their own property as if it was theirs. And because you have this agreement in place, it will be theirs at some point in the future. Now, they are going to pay a market rent. They're going to pay a market rent. Plus, they're going to give you an added credit every month. Okay? this credit it's separate than their rent, and they pay it to you separately. So for example, if the rent is $1,000 and they have a credit of $300, well, it'll be $1,300 rent payment. They give you $1,000, and then separately they give you another $300 for this option to be able to purchase in the future. And that credit accumulates. It's like forced savings, and by the time they get to the end, they have the down payment that is necessary for them to transact. So let's look at a case study of this particular deal. We have a deal here that we purchased at $210,000. Okay. Now, it needs to be understood that you are doing this as a business. You're a business person. You're an investor, and so we purchased that property for $210,000. But we have an agreement with the tenant buyer that we're going to sell it to them at $240,000. Okay, so the $30,000 upfront profit that you're going to make, I mean, this is for you taking on all of this risk, right? The $240,000. This is the option, the rent-to-own option price. So they have agreed to buy it. And why would they do that? Well, it's normal. If it's a 5-year term, roughly what we've done is 3% per year. Anybody can understand that, and in fact, that's up to you to negotiate. So we bought it at 210, but by the time you transact, so this is now you speaking with a tenant buyer. By the time you buy this property 5 years into the future, it'll be worth more. And so you're going to buy it today. You're going to agree today on what you're buying the property for 5 years from today. You get your $10,000 deposit, and you're going to use that $10,000 to put it towards the down payment. Of course, making it easier for you to transact on that deal, because you can use some of their deposit money or their option consideration deposit money in order to transact on the deal. So for example, this particular deal, if you had to put $40,000 down, for example, you would have to put 40,000, but now it would be 30 because you have the $10,000. So you're using their $10,000 in order to help you purchase the asset, and now you give a rent. In this case, the rent is $1,500 plus a $300 credit. Okay, so total they're giving you $1,800. Now this $300, it doesn't seem like much, but $300 times 12, that's $3,600 a year. And over that 5-year term, that $3,600 turns into $18,000. Plus the $10,000 they already gave you, that means they have on credit $28,000. Okay? So over time, because it's like a forced savings, you actually created a situation where they can accumulate their down payment. And so that can be very powerful. Now let's see the transaction on closing. So now you get to the 5 years, end of the term. On closing day, purchase price $240,000. Okay? Now here's the thing. The deposit, this $10,000 is non-refundable. The $18,000, any of the credits, is non-refundable. Meaning if they walk away from this deal, they're not going to walk away from $28,000. And so it's not logical for someone to do that, right? And so in this case, because it's non-refundable, it's not like you have to come up with it at the end or you have to keep it in a separate account. You are free to use that money as cash flow for your business, invest in other deals. And so you've received $28,000, but it doesn't have to be ready at the end of the transaction. Because when we get to the end of the transaction, When we get to the end of the transaction, it's simply an adjustment at the lawyer's office. So I'm going to show you how this works. So we're now closing the deal at $240,000 5 years from today. The seller, the buyer, the buyer has a credit of $28,000. So we minus the $28,000 from the 240. But remember, that money doesn't disappear, because remember, you made the $30,000. Remember the $30,000? You have it now in your hand, okay? And so what's happened is this money, you've already spent it. And so and that's part of your profit. So when you sell, because logically what someone would think, it's like, oh my God, I'm going to be negative $28,000 at the end of the deal. But remember, you bought this deal for $210,000. You didn't buy it for $240,000. You bought it for $210,000, and now you're doing this transaction. This was your profit. You've already spent it. But here's the bonus. Here's the bonus. The bonus is the pay down, the mortgage pay down. Throughout the 5 years of this transaction, you have the tenant buyer has helped you pay down the mortgage. And so roughly, based on these calculations, it's going to be another $30,000. So not only did you make the initial 30 up front, plus cash flow throughout the time of the transaction, but now you're making another 30 in your pocket because you bought it for 210, and you obviously put like 30 into it. But then the mortgage has been paid down during that time. And so not only did you didn't put any time into this deal, because there is no property management, because the tenant buyer owns the property and is responsible for the property. You made really, really sexy cash flow during that time, and you were able to pocket now $30,000 plus the $30,000 that you put down. So not only did you receive this $30,000, but you get an additional $30,000 on the pay down, and your own $30,000 back. So you're walking out of there with $60,000. And so that can be an extremely lucrative type of deal. But let's follow it. So closing, $240,000, credit, okay? We simply adjust. We simply credit back to the buyer of $28,000. Now the buyer has to come up with 40, right? 40 roughly about $48,000, which would be 20% of the 240. So if the buyer has to come up with this $48,000, what you're going to see is that they're still going to the buyer will still be short the $20,000, but they're planning for that. I mean, the second you sit down with this tenant buyer, you're going to be able to you're going to be able to say, listen, by the time you get to your 5 years, you actually need an extra $20,000 to transact. What if they don't have it? Well, if they don't have it, they can always extend the term for another 5 years, but you'll have to add 3% per year. And so you get to, so if they buy it, great, you make money. If they walk away from this deal at 5 years, great, you now keep everything. If they extend, well, you now make more money because you add another 3 to 4 or 5% per year, whatever you negotiate. And so there's really no chance of losing here. And so here's the biggest thing. In the 5 years, not only did this tenant buyer accumulate the $28,000 of credit, but in the 5 years, the value of the property is way higher than the $240,000. For example, I just did a deal like this where they extended it once, and we had a purchase. We had an agreed purchase price of $240,000, but the property was worth $500,000. So that means this tenant buyer had the ability to get into the game and build $250,000 of equity without imagine they would have waited until the time was right, until they had the down payment, until they had their job and their credit all in place. They would have missed the market. And so this can be a lucrative way for someone to get into the market, for you to know that you have this strategy in your toolbox. You could be the tenant buyer and get yourself a duplex or triplex, or maybe on my level where I'm buying apartment buildings, I'm doing agreement for sales. I have the agreement in place of me purchasing this apartment building at some point in the future, but I have this master lease that gives me the ability to control all of the units, all of the units, all of the expenses, and cash flow from a property that I don't even officially own yet. And so that is rent to own. Now I do have the slides. I'm going to go into the PowerPoint, but for that I'm just going to log off here.